Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They have also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Rule Radio. There is so much going on in the world and the market. It's almost hard to say that we can keep this to a 10 or 15-minute show. We'll try to hit some highlights here. First, let's hit the markets with gold at $1,779, silver $2,595, platinum $1,091, and palladium $2,688.
Yeah, that's indicative of a lot of price swing here in the last 2 weeks.
Yeah, it sounds like a couple of those prices might be down in the last week.
Sure enough. Yeah, Thursday and Friday saw down moves in gold, silver, platinum, and palladium.
Yeah, we had a fantastic drop in the metals prices, right sandwiched in between, I would call two pretty decent events. One last week I discussed on the show had to do with some Fed announcements regarding adjusted inflation rates, up 0.5 point from their expected inflation rate in 2021, as well as a very pressing expectation of raising interest rates at some point in the next unknown number of years. So following on the heels of that, we also had the options expiring last week, and we saw a pretty decent drop in the gold price right prior to the option expiration date as gold had been up. Shocking to see a number of people who might have been holding those options to expiration ended up walking away with $0, if I'm not mistaken. Possibly even one or two coworkers of ours.
There you go. And it's not only the metals prices that were impacted, but indirectly and resultingly that occurred due to the dollar. And I'm sure we'll get into the U.S. dollar too and what it did in response to Chairman Powell and the words out of the FOMC. And, that's podium talk. Call it what you will. It's absolutely market intervention, for lack of a better term. But let's talk just about the gold price to begin with and look at the price swings there. And where were we a week ago and where are we now?
Sure. So we're looking at gold topping out around 1917 here, end of May, beginning of June. That would have been the highest price we put in after we hit that 1678 bottom. Going back to some of our earlier shows this year, some very strong resistance levels there that it did hold and did bounce back up from. So it wouldn't be surprising to see gold start stair-stepping up like it had been stair-stepping down. But we did in a week have over $100 drop in gold, which I know got a lot of people's attention. However, when you zoom out and look at the whole forest, not just the trees, we're still looking at a pretty shallow correction and not putting in any longer-term lower lows. Doesn't mean that gold couldn't continue down further. Obviously, we've yet to put in a significant higher high in gold since we peaked back last year in 2020. We peaked just shy of 2,100. We've been stair-stepping down. We found a pretty significant bottom at 1678. We've had a very strong climb since then, but that climb has not exceeded the previous high. So we still need to see a higher high and a higher low. Now, we could be putting in a higher low here, which means the next move up, should gold continue up from here, would have to break well up into the 1900s, possibly even around 2000. If gold were to continue down, well, obviously we've got some lower points written on the chart if we're still in the longer-term bear market. Personally, I feel like the announcement regarding expected inflation will outweigh the announcement regarding rate hike because the inflation is happening now. Rate hike is at the earliest a couple years from now.
I agree. The rate hike doesn't have a specific timeline. They said 18 to 24 months, but they're going to wait on the data. The data is going to dictate. Secondly, inflation doesn't have a projected end date. It hasn't even slowed. It's only continued to climb. And as a result of that, with adding to the issue with monetary policy and Fed intervention and the huge swell in the money supply, to me, that's the current reality where they state that it's 5%. But if you go back to the way it was measured in the 1980s before they fudged the formulas in order to make it look better, as John Williams points out in Shadow Government Statistics, it's actually exceeded 13% now for the first time in over a decade. So that is our real inflation rate. And the three of us and anybody else listening can attest to the fact that that 13% is conservative for many asset classes.
Well, and kudos to the Federal Reserve. We should give credit where credit is due. I do congratulate them for being willing to raise that number from 2.5 to 3.5. I mean, that is a big emotional step for them, willing to take it. It only took the national price of gasoline doubling in the last couple months for them to be willing to say, hey, maybe it is a little bit higher than we've sort of been saying it was. I don't think anybody out there in the entire country had any question that it was higher than 2.5%, anybody that follows the economics and the cost of living. But I do appreciate them actually coming out and saying it's a little bit higher. Now I'm looking forward to them saying it's actually quite a bit higher than what our stated rate of inflation is. Like you pointed out with John Williams and Shadow Stats, going back and tracking inflation based on the government metric used 40 years ago. If you don't like the answer, just change the math.
Yeah, inflation is the theme of the day. And I mean, whatever the Fed speakers want to say, how many of them come out publicly and start talking? Like, when was this normal? This is, I guess, the new normal for all these Fed officials to just get on the microphone and say all kinds of things, whether they're real or not. But the inflation rate, obviously higher than their threshold, obviously higher than what they want to use. They're using the PCE inflation rate instead of the CPI, because the weights of both used cars and shelter are much bigger in the core CPI than they are in the PCE. And health insurance prices are not included in the PCE. So it depends on how you want to measure it, but everybody who lives and buys things sees inflation. I think if you have any worry about what's coming, inflation is coming. It's already here, but it's coming harder. And this is the time that you need to be adding to your metals positions. It's the seasonally weak month for gold. It's June. It's done exactly seasonally what it should do, which is come down from last week. As we go into July, August, September, I bet that we're going to see gold strengthen. So if you have any fear of missing out as the silver wave started to come on in the last number of months, fear of missing out, I have fear of missing out because I think metals are about to explode higher. I mean, look at lumber, look at some other commodities. I think metals are going to do something like lumber. If you've looked at lumber lately, you've got a sheet of plywood, $70, $75. When was that ever the case? I don't think ever we've seen plywood that high. Metals are going to follow, so you need to be buying at these levels. We've had gold price come down and hit the 618, like Miles has pointed out, and it's bounced off it for the last week. So this is the range where you can be buying. Maybe it takes another leg lower, but when it finishes this downward trend, you just want to be in it because it's going higher.
Well, and all of these precious metals have been sitting inside of trading ranges. Nobody's broken to a lower trading range. I mean, you look over at the silver chart, the silver is still quite a bit above its rising floor. Even after the decline of a couple dollars last week, no big deal on silver, opportunities speak. Same thing with platinum. You look at platinum taking a really nice drop last week, still sitting above $1,000. I mean, platinum wouldn't be anything resembling bearish till you're down well into the 800s. So it's got a long way to go before you could argue anything long-term on the downside with platinum. Palladium, same thing, hasn't put in any semblance of a lower low. Of course, neither has the Dow. Although the Dow did take a nice drop here and did actually put in a lower low, slightly below the May lows, but not enough to write home about. So none of the markets, it doesn't matter what you're looking at, whether you're looking at commodities, you're looking at currencies other than the US dollar, you're looking at the equities market and different sectors within the equities market, everything is climbing, and I don't think it's a healthy climb.
No, it's not a healthy climb, and yet these can be perceived as healthy declines in the precious metals because they do provide value in a market where really the fundamentals could not be stronger for gold and silver, and they couldn't be weaker for the dollar or the equities markets. So here you get this bonus of value in a really strong fundamental environment. We're talking about technical strength today where nothing really has changed other than, again, presenting some value. And all of this is expected when you see the dollar do what it did. And I don't think some of it was intended. The Fed, Robert, you talked about like yesterday morning, 3 Fed presidents come out in one day and talking totally dovishly. I think they're backtracking a little bit saying, we don't know when we'll raise rates, but it had its effect. Well, it didn't just drive the dollar and drive gold down. It knocked the equities markets down too. And that's the last thing they want. They need to keep this thing rolling. The economy is picking up, but it's in serious trouble. Business cycle conditions are still collapsing, and inflation is going to add to that. So inflation is not just the word of the day. It's the word of the year. And with supply chain disruptions, which nobody wants to address, which are still lingering with COVID, there is no predictable. Those are going to continue way into 2022. There is no predictable end in sight. Is it transitory? Under what time frame? Eventually you get it reined in. David's talked about that. Inflation being a runaway horse that they hope they can eventually rein in, whereas deflation is a dead horse. So they would rather have this. So get prepared for it for the long term.
Well, what else was transitory over the last 100 years? The decline in the dollar value? That's transitory. Eventually it's going to end and the dollar's not going to exist.
It'll probably still be called the dollar. It'll be a completely different thing. I feel like we just did that 50 years ago. We still call it the dollar, but it's a different thing. You know what the Fed presidents remind me of? It's kind of like, you ever watch CNBC and that 22-year-old kid wearing his dad's suit comes on TV as the representative for like the big multinational corporation, and they're interviewing this junior vice president fresh out of college, and you're like, this seems like the wrong guy to be talking about the future earnings of the company. And then 2 weeks later, you find out the company is bankrupt, and the reason he was the one on TV is because all the other guys were packing up their offices. It almost kind of feels like that. When you have 6, 7, 8, 9 Fed chairs all trying to give the same speech at the same time on different networks, does that feel like they're actually encouraged and excited about what the future looks like?
No, it sounds like unintended consequences trying to be cleaned up, or it sounds like outright, again, market intervention or manipulation. And I'm smiling about these prices in this short period of time. Now, remember, we had a really strong 2-month rally in the gold price that you just pointed out. It predicted these inflation numbers before they were released. We're talking decades-long records in measurable inflation, even measured the new way that they do it. That's why gold was up $200. Okay, so we gave half of that away. It still has priced it in. By owning gold back in January, February, March, having acquired more ounces, you're still ahead and still happy that you did so. Gold down 8%, silver down 9%, platinum down 13% just in the last month in terms of those recent highs to lows in this little bit of a pullback. That's unbelievable value to me.
Well, Miles, I can't help but bring up the 1971 reference that you made. For those of you who may have been born since then, you may not know the history there, but that's when President Nixon took the dollar officially off the gold standard and quit redeeming dollars for gold. And the point I want to make here is the dollar and gold had this relationship. You had a backing of the dollar by gold. That was at $35 an ounce in 1971. And I think taking it off the standard was supposed to be temporary, by the way. Still temporary, still transitory. But here we are 50 years later, 2021, and gold is $17.78 or whatever it is today. That's a 50-fold increase in the price from 35 to here we are, $17.78. 50-fold in 50 years. That's with an inflationary 1970s. That's with Volcker raising interest rates in the early 80s. That's with 50 years of history. What the Federal Reserve and the government has done in the last few years is multiplying the money in supply at a greater pace than the last 50 years. So we're accelerating inflation, but even the inflation we've had over the last 50 has multiplied gold 50-fold. So if you think that the inflation rate is picking up and it's this thing that's going to not be tackled, I don't think it's going to be tackled. I think it's going to keep going. You've got gold at a place where it's going to be explosive over the next 5 to 10 years. If they're doing this now and over the last 50 years, it's gone up 50-fold. It's going to be an explosive move with gold. I hate to even throw numbers out there. It might even sound ridiculous to like try to put a price on gold, but it's headed higher and probably a lot higher as we get going in the next few years.
So I've alluded a couple times to the dollar and its response in the last couple of weeks. And so I'm going to pass that baton to you guys and show us the charts on the U.S. dollar and really what's happened now since we've gotten these Fed presidents coming out and stepping up to every public podium possible.
Well, the dollar had a lot of congestion around 90 on the index and was kind of building a little base there. And we said we wouldn't be surprised if the dollar had a rally from here, which is what's happened. And happened right after the FOMC meeting Wednesday last week. The dollar just caught on fire. And that's a reactionary move from expected tightening in 2023, by the way. And so the dollar had an explosive move. Gold basically mirrored it on the other side going down. I think that's a little bit reactionary. And the dollar seems to have kind of petered out a little bit and is pulled back just like gold has kind of hit that 618 and is bouncing around. Maybe the dollar has a little bit more to the upside. Maybe we have another little leg down to the downside with gold. I think it's in the next couple weeks we're going to find out, and we're going to hit a bottom with gold, and you better be in as we get into the seasonal strength in the gold price.
Yeah, but I would also add, going back to conversations that we've had over the last 6-12 months, Robert, you'd been pointing out, now this goes back a ways, but you were pointing out an expected bottom in the dollar last year and a reversal. Now, I think our listeners need to remember, because I certainly need to remember, that if gold is a bicycle, the dollar is a cruise ship. We're talking about the world's largest asset, and it takes a long time for that asset to change and move direction. So I think that what we're seeing here is the exact same bounce that you and I were talking about a long time ago on this show, because at the beginning of 2021, we put in that bottom in the dollar like you were expecting, and it started to rise. And despite the big decline in the dollar we had through end of first, beginning of second quarter, we still didn't really put in a lower low in the dollar. That's and it's
right.
bounced back up.
That's right.
So we could, over the next 6-12 months, see the dollar continue to rise up to some of the levels that we talked about, maybe 95, 96, 97 on the dollar, maybe not as high as 97, but certainly 95 or 96 before it turns and comes back down. So just remember, you're talking about a giant cruise liner trying to turn around right in the middle of the Panama Canal. It's going to take some time for that to happen because the currency is the biggest thing on the planet. There's no asset bigger than the dollar.
I think we've seen, however, that they really aren't about a real strong dollar.
No,
right
of
now.
course not.
So I think that will try to be controlled as well. And what was missed in the Fed announcement was the fact that existing stimulus and federal funds rate policies were expected to continue into the foreseeable future. That means nothing's changed. They talked about potentially changing in the future, but for the foreseeable future, everything dictates that they have to do this. And remember, you still have a very fragile domestic and global economy. Everything's tied together, whether it's the repo market or asset purchases or certainly injection of capital, money printing, money supply. They're not changing the game. And that's why I say the fundamentals have never been better for gold and silver. Take advantage of the discount. We're going to claw our way right back to where we just were. And then we'll be talking about what does it look like from there in terms of going and testing those previous highs.
And despite the time, I would still argue there is some reaction to the Fed announcement about interest rates, only because it's been decades since we've had a majority of Fed presidents saying, yeah, interest rates have to go up. Like, when was the last time that happened? Bush 1? Clinton, maybe?
And it's true. For long-term economic viability, that is true.
So just the fact that you've got a majority of Fed presidents, regardless of the time frame, for the first time in decades, in agreement that we can't keep this going for too much longer, we have to start letting interest rates rise at some point in the future. I just think that type of reactive announcement to anybody who pays attention to this stuff, of course that's what we saw happen in the markets.
Well, remember, too, all that really matters is the real rate of return. It's the interest rate that you can get on your money market, for example, versus the inflation rate. What are you losing with a weaker dollar? You talk about a dollar rally. Please hear us. That doesn't mean that it's a strong dollar. Robert pointed out the fact exactly how weakened the dollar has become in 50 years. And that's like death and taxes, man. It's guaranteed. The dollar will weaken. Just because the dollar index looks like the dollar relatively strengthened doesn't mean the dollar weakened. And Miles, you have preached this, and you're probably tired of hearing me even say it. But the reality of the fact is that weaker dollar is why you own the metals. That's the guaranteed part. And with a weaker dollar comes increased asset prices over time. That's why the equities markets go up. That's why the commodities prices go up. And we've seen a little bit of a pause, and it's not here to stay yet.
Yeah, and I'm glad you bring that up about how it's not really much of a rally. I mean, we're having a pretty long conversation about 1 point.
I think we must, while we're talking about the dollar, let's just wrap this up. I think we must point out, we're talking about the dollar index.
Right.
And that dollar index is primarily based on that dollar-euro exchange rate. So the dollar rising here, yes, gold sold off pretty well as an inverse relationship, but the dollar index rises to 95 or 96. It doesn't necessarily mean the gold price is going to give you a lower opportunity. Look at the dollar index compared to the price of lumber. Lumber didn't care what the dollar index was doing. Lumber just went multiple fold up. into crazy territory. So we want to be clear, this dollar index rising possibly to 95, 96 is a lot based on the exchange rates, or all on the exchange rates of the dollar versus a few of the other currencies, mainly the euro. So dollar, here we are, maybe it goes higher than 95, 96. Very likely that it could do that. But gold is going to find a bottom in here, and you want to be in before it breaks into the next 1900, 1950, 2000 range, because once it gets momentum, it's going much higher.
That's going to do it this week for Golden Rule Radio. We appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, head on over to our website at McIlvaney.com. You can also find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to talk about opportunities within your precious metals portfolio, give one of the advisors at McIlvaney ICA a call at 1-800-525-9556. Thanks for listening. Have a great week.